Us. Hey, everybody, it's Helmer. Today is November 29th, 2023. Here with your mortgage market update, your weekly rate forecast, where we kind of give you a heads up on what's going on with mortgage rates and educate you so that you feel comfortable when you're out there looking at homes or thinking about refinancing. Joining me this week is James Mercado. James, thanks for joining us. Please take a minute and tell everybody a little bit about yourself.
Great. Thanks for having me on the show, Helmer. I've been with Vetted VA since 2019. Been in the mortgage business 25 years. Run a nice operation in the Midwest. So I'm excited to be able to share some information with all of our members today.
Very good. Well, again, thanks for joining us. Remember, if you're here live, we love to hear from you. Go ahead and give us a hashtag live in the comments. Let us know also if you have any questions about what we're talking about, any questions about rates, anything that you want to share your thoughts on, the housing market, go ahead and ask, and James or myself will answer you. If you're watching the replay, of course, we appreciate you as well. We know many of you can't make it live, but a lot of you do watch the replay, and we love you when you go ahead and just put it in the comments, put hashtag replay. Let us know that you're here. Also, we do monitor this post. So if you do have questions and you're watching on the replay, go ahead and post them or share your thoughts. And if you tag James or myself, we can make sure that we get you an answer. With all of that said, let's go ahead and get into the good stuff, and let's talk a little bit about interest rates. Remember, this is not an offer to lend. And when we talk about rates, we're talking about averages and generalities. You always want to make sure that you are shopping around for your unique situation and getting the best opinions that you can get for yourself. So that said, what happened since last week? Well, rates have been about the same. Last week was the holiday week. We had Thanksgiving. Markets shut down. Things are very, very quiet, and we generally don't see a lot of movement. Last week, rates improved a little bit as we headed into the beginning of the week, and then gave those gains back as we headed into Friday. This week, though, we've seen just a little bit of improvement. Rates have been about the same or maybe a little bit lower. You might have gotten some better, what we call rebate pricing, the credit towards your closing costs, or if you're paying points, if you're buying down your interest rate, it may cost a little less to buy that rate down this week is what you may find. Generally, VA rates are in the mid to high sixes, sometimes in the sevens, depending on your credit and your unique situation. If you're getting quotes anything higher than that, you may want to look deeper. If you've already locked in an interest rate higher than that, you may want to talk to your professional and see if they can help you at all. Conventional rates, if you're not using a VA mortgage for any reason, what we call conventional rates, they're averaging in the sevens. So that could be anywhere from the low sevens for great credit to the high sevens for, your average scenario. So if you're getting a rate in the sevens, that's very normal right now. And, you're probably not having to worry about being taken advantage of it in any of those scenarios. Now, as far as where things are going from here, that's what everybody always asks me and what everyone wants to know. The worst rates should be behind us. And I thought that this was going to be the case in October, and it proved not to be. And I talked about a false peak, kind of a mountain climbing thing. If you reach up to the summit and you think you've gotten to the top of the mountain, and just as you get there, you realize that right beyond your sight line, the mountain continues higher. And that's what happened in October. We did see rates take one last jump and push up into the eights or into the sevens for VA rates. And it was a very unwelcome experience, but it does appear that it's been behind us now. The current outlook here in the United States as well as overseas is that the central banks are done raising interest rates. This was a global phenomenon post-COVID because so many governments reacted the same way by influxing stimulus, monetary stimulus into their economies and shutting things down. Really created a global epidemic, not the pandemic, but an epidemic of the economy. So that seems to be finally working itself through. The worst rate should be behind us. Tomorrow, we're going to get some inflation data. This is the Fed's favorite gauge of inflation. It's called the PCE. It's a personal consumption expenditures. Now, we got some inflation data earlier in the month. That's the CPI, or the Consumer Price Index, just a different report, but it is measuring similar activity being inflation. The CPI data did really well. It helped rates to improve a little bit, showing inflation has gotten just a little bit better even than what was expected. It was 0.1% across the board, but that tiny tenth was a mighty mover as far as mortgage rates go. Tomorrow's PCE inflation data, we're going to get that in the morning. we could see rates improve a little bit tomorrow because of that. It's unlikely that it goes against us, but it's possible. More likely, though, we'll see rates improve just a little bit tomorrow heading into the end of the week. So if you had a choice of locking in today or tomorrow, consider that. Of course, there's always risk, and you should talk to your mortgage professional, but at least you've got that in your pocket. The week of 12/4, next week, there is a lot of labor market data that we're going to get next week. We're going to be getting job and labor turnover survey data. That's called the JOLTS data. We're going to be getting ADP private payroll data. We're going to be getting non-farm payroll, wages, and unemployment data. And if we see any signs of a softening labor market next week, it's going to help mortgage rates to improve. In fact, earlier in November, at the beginning of November, we saw a slightly weaker than expected labor report, and it helped to rally rates and improve mortgage rates that we've seen improve through November. So there's a lot that could happen next week. And then following next week, the week of the 12th, it's the week of the 11th, the inflation report comes out on the 12th, and that'll be the CPI, Consumer Price Index inflation report. And the Fed has their next Fed meeting that starts on the 12th and concludes on the 13th, which we will have a Fed rate for a rate decision, as well as policy decision, and also a press conference. So there's a lot of activity over the next couple of weeks in December that could help mortgage rates to improve a little bit. And that's kind of what everyone is waiting for. So right now it's the Fed that is really having the biggest effect on mortgage rates. Markets are anticipating the Fed is done raising rates and that they'll have to start cutting rates soon. Right now, the idea is, and actually, James, I'm going to bring you into the conversation on this one because we were just talking about it a moment ago, but right now markets are anticipating the Fed is going to start cutting rates probably in June. And there's some entities that believe that we're going to have to cut it sooner than that. So we'll talk more about that with James in a minute. And then the last thing that I'll leave you guys with is that over the next couple of weeks, rates look likely to hold steady or could improve. We always see day-to-day movement, small movements day-to-day, but overall, we could see rates take another jump of improvement, again, heading into that second week of December. And, the later half of December, we could see slightly better rates. As we go into 2024, rates could start to move lower, but it's likely that it's going to happen slowly. And it is unlikely that we see any big moves that would bring us down into the 6s to the 5s to the 4s, back to the 3s. We'd have to see a huge global pandemic again in order to see rates in the 2s and the 3s again. More likely in 2024, we'll see rates that, push down. Right now, like I said, we're in, for VA rates, we could be in the 6s. We'll see rates that'll move into the 5s and possibly the 4s. So that's kind of what I anticipate. James, what do you think? What do you see is out there?
Well, Hammer, we've been around a long time, and there is no crystal ball, and this has been one of the craziest seasons I've seen in 25 years. Since March of 2022, the Fed's raised the federal funds rate 525 basis points, all right? Now Goldman Sachs is reporting that the drag on the economy is coming to an end, which is good, and that they're saying that the Feds are going to be forced now to start to do price reductions. Deutsche Bank, another big player in the market, has also said the same exact thing, that they're forecasting even 175 basis point reduction in the federal funds rate. So whatever that federal funds rate is, add 3% to it, you get your prime rate that affects your HELOCs, your credit cards, your home equity loans. All that data is telling us that going into 2024, you as the veteran who's buying a home or wanting to possibly do a cash out on the home, an IRRRL, is you're going to see a relief in pricing. We're not going back to the 2s or the 3s anytime soon, but what we will see is a relief. Pricing's going to come down. So I'm going to issue a word to the wise. Be careful on discount points right now. It's sexy. People are selling them. They're pushing them hard. But when you pay that money for discount points, and if rates drop the way Hammer and I are talking like they're going to happen, you don't get that money back in 210 days when you want to do an IRRRL. That money is money spent. So here's the slang way that we're telling our clients and our veterans.
Wait. Before you give the solution. Before you give the solution, let's just give everybody. So when you say, what is a discount point? A point is 1% of the loan amount. But when you do a discount point, you're paying money up front to bring your interest rate down. Doesn't always have to be a full 1%. It could be 0.5%. It could be 1.5%. Usually you'll get a couple of options, but you're paying money up front. And as James said, Once you pay that money up front, that money is gone, but you're getting your interest rate to go lower. So the only way that you recover this money is if you are in that loan for a longer period of time. And if your savings per month, maybe your interest rate would have given you a payment. Again, these are just numbers to make this easy to understand. If your payment would have been $1,500 a month, but now you've paid $5,000 up front and your payment goes down to $1,300 a month, well, that's $200 a month, but you're only saving $2,400 a year. If you're in your loan 10 years, well, then you've saved $24,000. Life is good. But if you're only in your loan for 1 year, well, you've spent $5,000 to save $2,400, which means you lost $2,600. That's what a discount point is. That's how that works. That's and the reason that you may not want to pay discount points now, James, explain to them, why wouldn't they want to pay them now?
Because you're giving hard cash in exchange for a little bit lower rate. But the market, the analysts, and all the experts are saying rates are going to drop in 2024. So if you can just wait, and maybe it's a little bit normal rate, maybe it's the market rate, whatever that is. Let's say it's 7% for simple math. But if rates are, everyone's saying they're going to drop in summer and into the fall of 2024, then you can just have that 7% rate for the next 6, 7, 8 months. So you're dating the rate. You're not married to that loan, because the VA has a product called an IRRL, an interest rate reduction refinance loan. It's the easiest, simplest loan to do in the world. Very, very simple to do. So now what happens is, date this rate, get into the house while you can still negotiate a good deal. And when rates drop, do an IRRL and take advantage of the lower rate. It allows you and saves you a bunch of money. Instead of giving cash up front to get a lower rate today, take the market rate today, shop around to get the best deal, and then do an IRRL in summertime. That's what I would say to people.
Yeah, and I agree with that. Now, so that everybody understands, an IRRL, your interest rate reduction refinance loan, there are some, I call them restrictions or requirements to that loan. James, what are some of the things that people need to realize? If they got a mortgage 2 months ago, can they refinance? Can they do an IRRL today?
Excellent question. So just so you know, if you do it, you have to have an improvement on your note rate of at least 0.5 point, number one. Number two is, if you do it, whatever loan you take out today, you have to keep it for 210 days. So the VA will not allow you to do an IRRL for 210 days. So you have to wait a little bit on that as well. Not the end of the world. You can start the process. You just cannot close and fund on the new loan for 210 days. But if rates drop, you can get that rate locked in, and you can just wait if you want to do that as well. So those are some of the simplest things to remember: 210 days and 0.5 point.
So somebody in the comments said it's still not worth it. Clarify for me, commenter, and I'm sorry I don't have a name. What is not worth it? Let us know what you think is not worth it, so we can either agree or disagree with you on that statement, because I don't know quite what that means. But I think it might have been on the example about with the points and everything, maybe. So just let us know what that means on there. So James, if somebody is getting a home today and we think interest rates are going to come down, we talked about that they would have an opportunity to refinance with the VA program, especially with a much easier process, a less expensive process, to go ahead and bring their interest rate down later. So that's a good thing. But why wouldn't someone just say, hey, I want to wait until rates come down altogether? I'm just going to, if rates are starting to move, why wouldn't they wait until the middle of next year or the end of next year to buy a home if they're happy with their current housing situation?
Excellent question. And that's a legitimate concern that we're talking to people about right now. The reality is this: there is still a shortage of homes for sale. And that means when there's a low supply, there's still an ample demand. There's still plenty of people that are willing to buy a house at 7% today because they just got married or they have kids now and they want to own a piece of the land that they defend. People are still buying today like crazy, civilians and veterans. So with a low supply and still a strong demand for housing, that's pushing housing prices up. And depending where in the country, some are still rising a lot and some are still rising a little. The longer you wait, the more expensive it's going to be for you. So I would suggest, if you can find a property you like now, secure that, lock that sale price in now, take advantage of it now, and also take advantage that the VA has the provision for the Earl product. You don't need another appraisal. You don't need to go through the complex underwriting of anything. We don't need to get your income documents for an Earl. It's easy peasy, lemon squeezy, as my daughter says, all right? But you lock in an aggressive price now. You're going through the winter. There's some deals to be had. I would encourage everybody, if you're thinking about it, now's the time to buy.
Okay, so we got some comments. Matt Mayo points out, he said the ticker says 6 months recoupment period, should be 36 months. Actually, I think that you read that incorrectly, Matt. What it says is that you have to make 6 months. Oh, you're recovering your closing costs in 6 months. Should that be 36 months, James? Did Matt catch a typo on this? I'm sorry, we have a little bit of a delay.
There's a 36-month recoupment period on the cost of the loan. There's a half a point improvement.
Right. So, but it's missing the 3. So good catch, Matt. I appreciate that. So Matt caught that the recovery of closing costs can be done in 36 months. Doesn't have to be within 6 months. So awesome. Good to know, Matt. Thank you for bringing that up and sharing that. Again, that's why we have our VA professionals, which I assume Matt is one of. Facebook user. So here, hopefully James kind of dealt with this question here, but so originally this person said, still not worth it. And then I said, what did you mean not worth it? And said to purchase at these rates and wait for the rates to drop. What if it takes 2, 3, or 4 years for rates to drop? Before you jump in on that, James, couple of things. Number one, the best time to buy a home is when you need to be or want to be buying a home. Now, I will say there's not always the best time to buy a home. There are the worst times to buy a home. Buying a home in 2007 was the worst time to buy a home. There are things that we can look for as professionals to tell you why it's a bad time. Now, we get a bad rap. Right now, I am not a mortgage broker or a mortgage lender, by the way. I'm not a real estate agent. So I don't have that same correlation. I'm in the industry 23 years and I have been an originator before and an executive for years and things, but I'm haven't been for years. But the industry gets a bad rap because it's like, well, real estate agents or mortgage people, you're going to say it's always a good time to buy because you need to do loans or you need to sell homes. And therefore, why would it be a bad time? And that's not true. Again, there are bad times to buy a home. When we look at, if they're like when we saw the way that prices were skyrocketing, I know a lot of mortgage people and a lot of real estate agents that said, hey, you need to be careful buying a home where you give up all of your rights to inspections, where you're paying this much over the asking value. They were counseling that that's a bad time to buy, and that's proven to still be a good time. But there are definitely some bad times. But as far as why purchase at these rates and why not wait for rates to drop, let's do this a 2-part question. Why purchase now and not wait for rates to drop? And then James and I will explain why rates absolutely will drop sooner than 2, 3, or 4 years, even though we don't have a crystal ball. We'll show you why we make that statement. So the first part is, why would you buy now? Well, let's say that rates do drop. James, what happens to the home prices when rates drop?
So what's going to happen is you're going to see home price continue to rise. And if rates do drop, home prices will rise even more because more buyers will jump in the market now that maybe couldn't afford it before, or maybe they were waiting for rates to get lower, so they've been sitting on the sidelines. So you're going to see an influx of more buyers, which means more competition, which will drive housing pricing up.
Yeah, and I agree with that. I know there's a little bit of a delay, so I'm throwing this up on the screen so you guys can see. Normally what happens, you have a fulcrum, right? This triangle that's here, this is our affordability, right? Normally in a regular market, what should happen is that everyone has their affordability level, what they earn, what they can afford for housing. As rates go down, home prices go up. So if rates are on one side, that drives the payment lower so people can afford to pay more for the home because their payment, because the rate being lower, if the home value is higher and they have to take a larger loan, the payment is going to remain similar. It's going to be the same. It's right here on that fulcrum. Normally, what would have happened is that when we had seen rates go up, as we saw over the last 18 months, what should have happened is that prices should have come down. Wouldn't have been a housing crash. It would have been the normal economics of how it works with the affordability. However, this scenario here did not happen this time. And the reason that this did not happen is, for lack of a better term, we're going to call these the golden handcuffs. All right. So golden handcuffs were all the people that had either purchased or refinanced. And we're talking, tremendous numbers of people that got into 2% or 3% interest rates. And they're in a home, and normally they would either move up or maybe move down. Maybe they've gotten, their kids are out of college. They want a smaller home. Maybe they've just had kids. They want a bigger home. Normally people move around in the housing cycle, and they go from home to home to home. And there's, one home's open, another one, as people move into another one. Well, people that were in these homes at 2 and 3%, they've stood pat. They've not moved. So we have a tremendous problem with inventory, and inventory is what is keeping home prices up right now, because it's always supply and demand, and there's not enough supply, even with a greatly diminished demand. Bless you. Normally rates going higher would lower the demand. And then when your neighbor wants to sell, well, there's less buyers out there. There's more homes on the market. How do I separate my home? How do I get attention? Well, I might have to bring my price down a little bit. And that's the natural equilibrium that takes place. That didn't take place this cycle. But what will happen is that the prices that we're at now, when rates go down, we are going to see this happen, just like we saw this happen during COVID, when everybody went nuts, when rates dropped down and prices were going extremely crazy. That will happen again. So this is actually a sweet spot where you can buy a home as long as you can afford it at a higher interest rate at a lower price. And then when the interest rates fall, you still have your price because that was locked in because you already bought your house, but you can then refinance and take advantage of lower interest rates. If you wait, lower interest rates will most likely, and this is, again, we don't have a crystal ball, but this is how economics work, it's going to lead to higher home prices, because the more people that are out on the market, people are going to come off the sidelines. More people are going to be able to afford higher home prices, and that's going to then allow home prices to rise. James, anything you would, before we jump and talk about why rates will change, anything you would add or change about that comment?
Yeah, a lot of people say, no, what about 2008? And the biggest difference between now and 2008 was inventory. So what, to your point, Helmer, is there was plenty of houses for sale in 2008 with less buyers. Now there's not as many houses for sale with more buyers. It's really that simple. So this is not a 2008 repeat. Period.
Yeah, not even close. Not even. And I was writing loans in 2008. Now, as far as why are rates going to come down, I'm going to throw the screen back up, and we'll kind of show you why rates will come down. So let me get rid of this little piece here. This is what we call Fed futures, this graph, and I've shown this on the show before, right? Yeah. So the first things first, I'm going to jump over to an actual chart. These are what we call Japanese candlesticks. This is the actual basis of mortgage pricing. Mortgage rates are not decided by a bunch of guys around a round table like the old commercials used to show. Mortgage rates are based on economics, specifically the bond market and a particular kind of bond called a mortgage-backed security. As you saw this 10-year treasury yield go higher, that actually ripples through the entire economy. And again, I'm oversimplifying some things, but this is the basics. And our mortgage rates also went up. Mortgage bonds had to react and do similarly. As we see this 10-year treasury yield go down, we're going to see mortgage rates improve, and mortgage bonds are going to improve, and all this other stuff. Now, we've seen this 10-year treasury yield was as high as 5% in October, and it's down to 4.29 today. Now, why has it gone down so much? Why has that yield dropped? Well, that has to do with the fact that markets believe that the Fed is done raising the Fed funds rate in order to quash inflation. This is the Fed only has one tool. When you only have a hammer, everything looks like a nail, right? So, I mean, they have one tool to use. Basically, they have two. They had quantitative easing and tightening, and then they have this Fed funds rate. They've driven the Fed funds rate from lowering it to zero during the pandemic to try to keep the economy humming, to then now raising it up over 5%. But that's too much too high. It's kind of like a rubber band effect, right? So we've gone way too far in order to bring inflation down. So what's happening is that we know that from normal economic theory and past experience, what is going to happen is the economy continues to slow down, consumer spending reduces, labor gets more of a struggle, unemployment goes up, and the Fed has to find what they call neutrality or their neutral rate. Right now, everybody, including the Fed, says, hey, we have gone and raised rates higher than what can the economy can normally handle. We're going to bring those rates down. And this is already forecast for 2024. And that's where you have either a little or a lot. But either way, it's going to help mortgage rates come down a little or a lot. The normal expectation is that we're going to see maybe rates will go down to 4.5 by the end of the year. That's what a lot of forecasts are right now, maybe 4%. That would be a full over a 1% change because we're at 5.25 right now for a round number. That would bring us down 125 basis points. There on the low side, there's expectations that we'll see 3 rate cuts next year for 75 basis points. On the high side, you've got 175 basis points. Is that what Deutsche Bank said? 175? Yes, yeah, correct. Morgan Stanley even said, I think like there was somebody that was even saying 3. So you've got expectations that we'll definitely see something of a rate cut. Now, when we look at all the economic indicators going on, where people are spending money, how they're spending money, where the consumer confidence is, all the manufacturing data, the inflation data. When you look at all this stuff and read it, the forecasting is that, yes, rates are going to move down in 2024. It will not likely be significant. I'm not telling anybody, hey, you want to wait until rates come down, into 3%. But we do expect them to come down. Granted, in all fairness, though, we did expect them to come down in 2023, and they didn't. However, that was because we never saw the heavy recession that we expected. We got what we call a soft landing. There's a lot of arguments on why that is. My opinion, the reason that we've seen the economy as robust as it's been and we've seen a soft landing has to do with consumer credit. I think people are spending money they don't have. I think that credit cards, we've seen that the number is high. It's a record number. It's over $1 trillion. Credit card debt. My son just bought he bought an F-150 last night. He spent $58,000 with zero money down, and they would have let him spread a loan out to 72 months. That's 6 years. But he's doing a 4-year payment, and that is $1,300 a month. But he was able to spend $60,000 yesterday with a signature. He did, and he's 25 years old. He didn't have to. So that keeps the economy going. That keeps those trucks moving. Ford doesn't have to lower the price of the trucks when people are buying the trucks. People can buy the trucks if they can buy the trucks with no money down and take 7-year loans on them. So all of this consumer credit has actually kept that economy going. What happens, though, is that the banks kind of start to realize, okay, we're in too deep, and they're going to start to clamp down on that credit. And a lot of consumers realize, hey, we're in too deep, and they start to slow down on spending. And we're seeing signs of that already. James, go ahead. I know you're nodding your head waiting to jump in on this.
Yeah, no, that's a spot on. The reality is money was so cheap. Picture like a race car, how that engine just kind of gets super, super hot, all right? And then what ends up happening is like, oh my God, we're going to blow the engine. So the Fed's like, we got to slow this baby down without blowing the engine. That's what you said, Hammer, is a soft landing. So they slow this thing down. But now the fear is we're going to hit a stop. And we can't let this thing hit a stop. So to prevent that, they're going to start to bring the rates down so we can start to ease into how grandma drives, not how the race car driver drives. They want to get this thing slow and steady because that's what wins the race. And that's where we're going in 2024. That's why we believe that rates will come down because the Feds do not want us to hit a wall and crash, period.
Yeah. So that was, thank you, Matt.
And the federal funds rate is the rate that banks lend between other banks to keep it kind of simple. It's a very simple explanation. All right.
Yeah. No, there you go. Thank you. It sounds like you picked up the slack. I'm on my Starlink, and it looks like it glitched for a minute. So anyway, yeah, it looks like you answered that. And then just to give Sammy an update as far as, let me just pull up that slide again, and I'll show you. This is kind of where I'll leave with this and we'll wrap it up for today, is that as far as where rates are, Sammy, let me throw this back on the screen for you. Rates have been, VA rates are in the mid to high sixes, sometimes in the sevens is what you're going to find right now. And conventional rates are averaging in the sevens. So for mortgage rates, this is more of what we're expecting to see. So anyway, well, everybody, again, thanks for joining us. James, thank you for sharing all of the great insight with us this week. Appreciate having you here. And I hope you join us again. Everybody, remember, you can jump on every Wednesday. We do this 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. And, you guys can always join us and ask questions and see kind of where things are going and what's going on. We actually have good things to speak about. It's been a long time since I've been able to be happy about being on these calls, because I usually have to tell you that rates continue to just be getting worse. Now we finally see that rates are improving a little bit. Don't get too excited, though. Again, the worst thing you could do right now is think, okay, I'm going to wait until rates hit bottom, because again, we'll continue to beat this dead horse, but you'll see home prices rise during that time. We don't know when rates are actually at the bottom. You'll always have those other options. You want to buy when it's the right time for you. There is never such a thing as the best time to buy, but there are worse times. This is not the worst time. So the best time to buy is when you need to buy. That said, it looks like just wrapping up on a couple of comments. Yep. Thanks, everybody. Appreciate all of you. And yes, James, anything that you want to leave us with?
No, just, you said it. Now is the time to do it. If you need it, your kids, whatever, you're getting PCS'd, just buy the house now. You can negotiate a good deal, and you can date that rate, and you can refinance it and later once you meet the 3 criteria that we outlined earlier.
There you go. So, all right. Thanks, James. Take care, everybody. Bye-bye.
Thanks for having me today, Helmer.